It didn't sound too optimistic going forward about a bunch of cuts ahead. They don't know the tariff shock, right? They don't know if that's just going to be a one-time chunk in price increase or if that's going to be a price increase that's just gradual over time. We definitely got an uptick in our applications a lot, but that was more on the refinance side.
I'm Karl Kyler, your San Diego Realtor. We're back with Matt.Kish of Movement Mortgage. We've had a lot go on. The Federal Reserve did their first rate cut of the year. We got Matt.Kish reporting to us exactly what it did to the mortgage rates, what it's doing to the market, and what you can expect going forward. So Matt.Kish, thank you for continuing to join us, continuing to update on this. Can you just lay things out, like what happened at this last Federal Reserve meeting?
So Feds cut the rate 0.25%, right? And the market and how we've been talking about expectations and how rates kind of move along with that, we noticed that the cuts for the mortgage rates already happened a couple months ago, a month ago, and that's why we see these mortgage rates drive lower in expectations of this cut. What it did directly, rates kind of jumped up a little bit the last couple days, and that's kind of what happened last year. Not so drastically as last year because we didn't have the labor report to kind of back up that information, but mortgage rates still ticked up 0.25 point, even up to 3/8 in some scenarios. So we kind of expected this, right? We talked about this and we kind of expected that these rates may jump up a little bit. They didn't jump up as much as they did last year, thank goodness. But I really think they'll reel themselves back in once the dust kind of settles.
So you think that rates will kind of trickle down? So the rate reaction of it ticking up is more of like a reactive response to Jerome Powell raising the rates, and you think they're going to settle down still?
Yeah, correct. Because now it's new expectations, right? So now they cut the rate, and now the rates responded to what Jerome Powell had to say. The dual mandate. They really want to keep inflation low, and they really want to keep prices stable, right? They want to keep the job market strong. They want to keep prices stable. But what they saw is the job market kind of weaken, and they saw inflation kind of tick up. They still made this cut, but Jerome Powell is not really, it didn't sound too optimistic going forward about a bunch of cuts ahead, because now with this new information, obviously with the job reports being revised, and now I haven't seen a job report lately. So with those numbers being revised and coming down, and seeing the demand for jobs going off and the supply for jobs going down, which puts us at a kind of a weird spot in the job market as well. Seeing this in real time, Jerome Powell kind of knows, hey, we made this cut even though we might not have needed it. And that's the language I heard. And again, that's my opinion. But he, you go back and watch the tape, he basically says households, even though, people on the lower end of the income spectrum are tight, but households overall are kind of strong. The stock market is almost at all-time highs, and they still made this cut, right? So it sounded like he was not pessimistic, but not optimistic. So they're really going to be neutral in their stance kind of going forward, because now it's really wait and see for the Fed.
I feel like this has been the regular, language every 6 weeks is wait and see, data. And, going into this, what you're suggesting that Jerome Powell's alluding to, I feel like I have been feeling this whole time, unemployment's down. And I feel the challenge we're facing in the labor market is because we got rid of the government sector of creating jobs. And then the BLS is doing all these radical revisions. And this is a whole other topic, but we have the stock market doing record highs, yet we have new job openings and unemployment extensions. Those are not reflecting this power position of our economy, on top of our unemployment being sub 5%. So it's like there's these, I was just not surprised that they were going to do that quarter point cut, but at the same time, I'm still wondering, what is it? Are they just doing that to abide by politics? Like politics have just been beating them up long enough for them to say, fine, here's your quarter point, get off our back.
I mean, we could all have our opinions about that, but I mean, for this cut, it was the ranking Fed members and the Fed vote to make this cut. Now going forward, looking at the Fed dot plots, and that kind of is the Fed's expectations in like an Excel spreadsheet form of how they may vote going forward with cuts, and everybody kind of cut back on that too. So again, now and even it's funny to hear Jerome Powell saying he's looking in the windshield and not the rear view mirror, and he said that verbatim, and I'm just like, wow, Jerome Powell really said that? Jerome Powell, the guy that's been looking in the rear view mirror for the last 4 years. But they are really trying to be forward thinking on this one going forward, because they don't know of the tariff shock, right? They don't know if that's just going to be a one-time chunk in price increase, or if that's going to be a price increase that's just gradual over time. They don't know if that's going to be something they have to contend with. They're looking at a labor market that's softening, but unemployment's still at 4.5%, which is pretty low considering, but you're seeing the trend get a little higher and higher on that tick. At the same time, seeing your dual mandate, which is inflation, getting a little higher as well, and you really need to bring that down. And if inflation is high, you're going to see mortgage rates stay a little inflated. Until inflation kind of ticks back down, mortgage rates won't follow.
So for the audience, I'd like to kind of rewind and just walk them through some of the basic economic ebbs and flows of what we've kind of been experiencing, and then hopefully you can just affirm it. So the Bureau of Labor Statistics drops this report where we're missing 250,000 jobs, and then they do another one where we're missing like almost 1 million jobs. And what that does is it causes uncertainty in the market. Investors move their money from, stocks and such like that, and they move it into bonds, and then that drives the 10-year yield down, which has a reflective value in mortgage rates. Then when you cut mortgage rates, and I am one of these people that did it, I put money into the stock market, because when they cut rates, it's kind of like the Federal Reserve turning on the money printer. When they turn money printer on, more money goes out there, the dollar devalues by prices going up. So you have the stock market going up, but what happens? People pull money out of bonds to try to ride that wave. Is that kind of on point?
Yeah, it's kind of on point, and you saw it that day in real time, right? You saw a lot of the mortgage rates kind of bounce higher because there was a lot of trading going on in all of the markets, right? And so you saw the yields go kind of wonky every which direction. But right now, the 10 years living at about 4.1. You don't want it to get back to 4.2. You definitely want it to get closer to 4. We lived close to 4 last week, which was really great until the Fed came out and made these cuts, and then they kind of bounced back up. But yeah, it's when it comes to how the money works in these markets, it's just these trends, right? You got to go with the trends and expectations, and if you're really forward thinking and you're really seeing the light at the end of the tunnel on any of these stocks, you can really put your money where you want it to be. And these investors really want the return on their dollar, and that's what I think they're waiting for when it comes to the 10-year. And that's why you see stock market kind of elevated, and you see the bond market not really moving and staying pretty flat.
Got it. So not that this is financial advice. We're not telling you to move your money from bonds to stocks or anything like that. We're just kind of giving you an idea of general economic, tug of wars that go back and forth. Go ahead.
Sorry to cut you off. And we're not talking about like normal everyday, Joes and Schmoes. We're talking about these big investors that are going to sway the pendulums on these big markets, right? I wish it was me and you, throwing our money at the market to make it change one way or the other. But it's these big banks, these big investors that are really putting their money into these places and moving the ticker on whether it be the stock market or the bond market.
Spot on. I agree. And so one of the things that we were probably missing last year, which So last year we had the Fed's cut rate, and then mortgage rates went up a little more significantly than they did this time. But what was missing last year was the labor reports, that the softening factor. So we have this like tug of war between, it's like, okay, well, we have this mass concern for our labor market. Oh wait, the Fed's cutting rates, which means, stocks could drive, and that's they're kind of pulling at each other, which is causing that mortgage rate or mortgage interest rates to go up, but they didn't go up as much as they did last year. Is that kind of consistent?
Yeah, correct. They stayed pretty flat, considering. Like I said, they ticked back up maybe about a quarter of a point in some instances, maybe about 3/8. In my opinion, we're hopefully going to gain that back here within the next couple of weeks. Again, when the dust settles, expectations of a possible other cut coming up in the next month, but the expectations of it might drive these interest rates down just a touch. And truthfully, we're hoping to capitalize on that if it does tick down, to make sure that folks that missed out before, the rate cuts, or the Fed cut and the interest rates kind of ticking back up, if we get to recoup that quarter point, that 3/8, we're going to get some people locked in to make sure, in case the Fed does have another cut and the bond market kind of reacts a touch negatively again, people aren't getting stuck on the sidelines.
All right, moving into the next question. I'm seeing a lot of people online. So the expectation was that we were going to get 2 Fed rate cuts by the end of the year. But there's a lot of people that are suspecting that we could get as many as 3, trying to get our labor market going again. Like, we just need 3. We got to get back to this what's called neutral policy. Can you give us your insights? Like, what do you think will happen if it's the case that we only get 2 Fed rate cuts? And then also, what do you think would happen if we happen to get 3? Like, can you do some light forecasting there?
Wow, really, really putting my crystal ball to work, today. But I would assume going forward, if there was 2 or 3, just small little peaks and small little valleys, going in and out, because we saw most of what was going to happen as far as mortgage rates, I believe, getting lower 2 weeks ago, right? 3 weeks ago, the last couple months. And now we're in a position to where they're going to stay pretty flat. We're going to get some good news, some bad news, where they kind of maybe tick down for a couple of days or so, or the inverse, kind of tick up for a couple of days or so. But truthfully, I think they're kind of going to stay pretty flat until the end of the year. I like I said before, I hope to recoup a couple of points here or there when we can really jump in and capitalize on those, so we don't miss out if the pendulum kind of sways the other way and we lose an 1/8, a quarter, 3/8 here on the upside once they do or they don't announce that they're going to make another cut. But I think this is kind of where we're living until the end of the year.
Got it. Can you remind us, with that being said, where rates ended last year about this time?
Oh, they were definitely ended a lot higher, because as we know from last year, when the October rate cut hit and the BLS job report hit at the same time, that's when, boom, rates really jacked up. And then as the month progressed, October into November, you saw them kind of try to come back up. And then, boom, another rate cut and another jobs report simultaneously, took our knees out. And then by the end of the year, rates were already so much higher than they were September 24 compared to December 24, that momentum didn't stop until this summer, right? So we really put a pin on it this summer. But the difference between the rate cuts last year and the rate cuts this year are pretty drastic.
Got it. So we're definitely in a much better position this third, fourth quarter of 2025 than we ended in third, fourth quarter of 2024. And as we've kind of talked about on these calls every other week about this, we've experienced, both you and I, the real estate side and then the lending side, have experienced buyers who have just been sitting on the fence for rates to come down, rates to come down, rates to come down. And during that process, buyers have finally stepped into a realistic perspective of like this idea of like, oh, when rates come back down to 4% or 5%, it's just like, whoa, that's probably not likely to happen in our lifetimes unless something really, really drastic happens to the economy. But now these buyers who have been waiting are finally at a point in their lives. Their families have grown, the job has moved, or they've been driving the distance for their job long enough, and rates have come down significant enough that buyers are starting to say, okay, cool, this is a significant enough jump now. Our incomes have grown over the last 2-ish, maybe plus 3 years. Now let's jump in on these rates. I saw recently, quote me if I'm wrong, I thought I saw a 30%, it was posted somewhere, I think it was Housing Wire, a 30% surge in mortgage applications. Now, I don't know that time variable. I think it was either a week over week or it might have been month over month. Do you remember seeing anything like that by chance?
I don't know the exact numbers. I get in, and truthfully, it's been really busy, so I kind of been keeping my head straight and narrow. But as far as our applications and our uptick, the refinance side, absolutely. But as far as mortgage application towards purchases, they've still been on the slower end, right? So being in the lending side, it's been pretty good getting a lower mortgage rates, because people that did purchase within these last 3 years in that bubble, post COVID rates and these higher inflated rates these last few years, actually got an opportunity to save some money. So especially these folks that have purchased these last few years, trying to save a couple bucks on their mortgage payments, because they went in knowing that they could kind of refinance in a period of time that was pretty soon, and thank goodness the time was now. But as far as purchase applications, I haven't really seen too many people get off the couch yet. I haven't seen too many people get off the sidelines yet and say, hey, what's my mortgage coach look like? Let's run these numbers again. I haven't really seen that, and truthfully, I've been shaking trees and been really, blasting out my database and letting people know, like, hey, the time is now. Because as we saw, we had a good 6-week, 8-week period to where we had rates really where kind of we wanted them. And now with the Fed, lowering their rate and mortgage rates kind of popping back up just a touch, we kind of lost that momentum. And again, hope to regain it back, but we did lose a little bit of that.
Oh my gosh, that's such a beautiful insight. Okay, so this is very interesting. I'm hearing on my side, buyers are getting to the point where they're getting antsy and they're wanting to, they're pretty close to, like, they're seeing these rates come down. They're like, okay, Karl, like, what would be the next steps and blah, blah, blah. And they're wanting to have these conversations with me. I think from my side, one of the challenges we're having in San Diego specifically is inventory. Our inventory is just barely over 6,000. So I have buyers that are interested, and they like go on to Redfin, they go on to Realtor.com, they go on to Zillow or whatever. They're just not seeing much available. So that might be why you're not hearing it on your side, because they're like, well, there's nothing really on the market for us to like go through this loan process with. Because how often do buyers start looking at houses before they get loan qualified? All the damn time.
Right. And let me put this, it's kind of, they're kind of hand in hand, right? If you're seeing a low dip in the workforce and you're seeing unemployment kind of go up and you're seeing people losing their jobs, the rents are high. So if you're losing your job and you have, and you're looking for another job and you're in a home with a rate within the twos, your mortgage still might be less expensive than selling the place and going and paying rent somewhere. So you might even be safer just staying where you're at, even if you do lose your job. So you might see, a lot of people in inventory, even with sellers, people not leaving their houses because they can't.
Absolutely. So let's rewind just for a second. When we see these, and I report on these times from time to time, right? I'll see data where it says mortgage application surge. Be mindful that could be micro data that's week to week or month to month, and it's also on a national scale, which I always make sure to mention in the video or the posting that I do with that data. Okay, it's always mindful. It's always advantageous that if, hey, I saw mortgage applications increase, I saw rates come down, blah blah blah. Contact me. Contact Kish directly and say, okay, what's happening in San Diego? What does it look like for me? Is this the right time? Maybe it's not. Hey, you know what? Maybe you got to pay off some more debts. Maybe you got to stash away a little bit more money. Maybe you gotta wait for your next raise. That's fine. Okay, talk to Kish. He'll walk you through those numbers. But just be mindful it's okay to look at all the headlines and everything like that. Like, be educated, but always follow up and say, okay, what does it look like for me here in San Diego? Because it could be different based on credit score, based on debt to income ratios, based on our inventory and our buyer demand. You know, just like Kish was saying, mortgage applications are up, but he's shaking trees and he's just like, kind of, people are still sitting on the fence. So would you kind of agree with that, Kish?
Absolutely. It's, you know, I still think a lot of people are waiting because it's an affordability thing too. It's still expensive, even if, you know, rates did come down a half a point, a full point for the price point that a lot of people are looking in. It's still kind of tight. So, you know, people are still, and again, there's still bad news out there saying that, you know, the housing market's going to crash and this and that. So the people listen to that stuff too. Again, these things are like fingerprints. We all got one. They're all different. We got to find out what yours looks like. And over time or right now, if it makes sense, it makes sense. And we just got to figure that out together. And once we do, we'll be in a better spot. Well,
Kish, thanks for continuing to support us and educate us and show up in these bi-weekly. We do this every other week to keep the audience updated on not just what the mortgage rate's doing and the mortgage market's doing, but also like how it's actually showing up for us here in San Diego. So if you have any thoughts, questions, concerns, I have Kish's contact info in the description below. Just contact him directly with your questions. Explore your options, explore different scenarios with him. He'll take great care of you. If you have any thoughts, questions, concerns for me, reach out to me directly. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you next video.